What is going on, everyone? Welcome back to the channel. Today is April 15th, 2026, and the market is serving up some absolutely wild price action. We have got an EV giant crashing to 52-week lows, Tesla staging a massive comeback, Morgan Stanley looking like it wants to break out to all-time highs, Oracle continuing its cloud-powered recovery, and Nike bouncing off deeply oversold territory. 5 stocks, 5 stories, and I am going to break every single one of them down with full technical analysis, volume reads, key levels, and 3-month price targets. Let us get right into it. Alright, let us start with the most painful story on our list today, and that is Lucid Group, ticker LCID. The stock is down over 7% today, sitting at $8.18, and here is the brutal part, that price is essentially sitting right on its 52-week low of $8.11. We are talking about a stock that was trading at $33.70 at its 52-week high. That is a drawdown of over 75%. This is not a correction, this is a complete collapse in investor confidence. Now let us look at the technicals because they paint an incredibly grim picture. The 20-day simple moving average is at $9.49, we are well below that. The 50-day SMA is at $9.88, crushed. The 200-day SMA comes in at $8.18, which is almost exactly where we are trading right now. So we are testing that 200-day support in real time. If this level breaks convincingly, there is very little technical support below it. The RSI is at 27. That is deep in oversold territory. Anything below 30 suggests the stock is being aggressively sold and could be setting up for a short-term bounce. Volume today is 16.2 million shares against an average of 14.2 million, giving us a volume ratio of 1.15. That elevated volume on a down day tells me this is distribution. Institutional players are selling into any liquidity they can find. Now, what are the catalysts here? Lucid continues to burn through cash at an alarming rate. Production numbers are improving slowly, but the company has no path to profitability in the near term. The EV space broadly is under pressure from tariff concerns and softening consumer demand. The PE ratio is 0, meaning no earnings, so investors are purely valuing this on hope and future revenue projections. Here is my honest take, LCID is a speculative play at best right now. The RSI does suggest a dead cat bounce is possible in the very short term. But fundamentally, this company needs continued capital infusions to survive. I am rating this stock a void. If you are already long, this is a critical level to watch. A close below $8 on high volume would be a significant red flag. My 3-month price target is $7, reflecting continued fundamental weakness, with support at $8 and resistance back up at $9.50 where the 20-day moving average sits. Next up is the stock everyone always wants to talk about, Tesla, ticker Tesla. And today, the bulls are back. Tesla is ripping over 7.6% to $391.94. Volume is coming in at 55.8 million shares, which is basically right in line with the average of 56.5 million. So this is a broadly participated move, this is not a low-volume squeeze. Real buyers are stepping in. Let us dig into the technicals. The 20-day SMA is at $366.98, we are comfortably above that, which is bullish. The 50-day SMA is at $391.10, and here is what is really interesting, we are almost exactly sitting on top of that 50-day moving average right now. This is a critical test. Can Tesla reclaim and hold the 50-day? If yes, that is a very constructive technical development. The 200-day SMA is also right here at $391.99, so we have got a convergence of the 50-day and 200-day right at current prices. This is what traders call a golden cross setup in the making. The RSI is at 52.1, right in the middle of neutral territory. That tells me there is plenty of room to run higher before this becomes overbought. This is not a crowded trade right now. From a fundamental perspective, Tesla is still trading at a PE ratio of 359, that is an extraordinarily rich multiple. But Tesla has always traded on vision, not just current earnings. The 52-week range is $222.79 on the low end to $498.83 on the high end. We are sitting roughly in the middle of that range, which means there is significant upside if momentum continues. Catalysts for the move today likely include positive sentiment around autonomous vehicle regulatory updates and continued strength in energy storage deployments. The 6-month low was $343.25, and we have bounced nicely from that level. My rating on Tesla is buy with medium confidence. The technicals are setting up well. Key support is at $366, the 20-day SMA, and resistance is up at $430 near where we start to see heavier selling pressure. My 3-month price target is $445, which would represent a move back toward the upper half of the 52-week range. Moving right along to the financial services sector, let us talk about Morgan Stanley, ticker MS. The stock is up 4.4% today to $191.41, and this one is closing in on its 52-week high of $194.59. We are talking about a stock that was sitting at $104.78 at its 52-week low, so the run from the bottom is nearly 83%. That is an absolutely extraordinary move for a company of this size and maturity. Here is where it gets really interesting technically. The 20-day SMA is at $168.70. The 50-day is at $168.97. We have completely blown through both of those levels. The 200-day SMA is at $191.40, which is almost exactly where we are trading right now. So Morgan Stanley is testing its 200-day moving average as a resistance turn support level. This is a textbook breakout setup. However, and this is important, the RSI is at 80.6. That is deep in overbought territory. Anything above 70 is considered overbought, and at 80.6 we are reaching extreme levels. This does not mean the stock falls tomorrow, but it does mean the risk of a short-term pullback or consolidation is elevated. Volume today is 4.99 million shares against an average of 5.92 million, giving us a volume ratio of just 0.84. The move is happening on below-average volume, which slightly reduces conviction in the breakout. Fundamentally, Morgan Stanley is firing on all cylinders. The PE ratio of 18.75 is very reasonable for a best-in-class investment bank. Wealth management continues to generate stable fee income, and if capital markets activity is picking up, which today's price action suggests, the earnings potential is significant. My take, Morgan Stanley is a hold here for existing shareholders. If you are looking to initiate a new position, I would wait for a pullback to the $175 to $178 range to get a better entry with a more favorable risk-reward setup. The RSI at 80 is the red flag that keeps me from pounding the table as a new buy today. Support sits at $175, resistance is at that 52-week high of $194.59. My 3-month price target is $185, accounting for a likely near-term pullback before a potential retest of highs. Now let us shift over to the technology sector and talk about Oracle, ticker ORCL. The stock is up 4.83% today to $170.88. Now before I give you my full analysis, let me give you some important context. Oracle's 52-week high was $345.72. The 6-month high was $311.09. We are currently trading at $170.88. That means even after today's nice gain, Oracle is sitting roughly 50% below its 52-week peak. There has been significant destruction of shareholder value over the past several months. But the technical setup today is actually constructive. The 20-day SMA is at $147.78, we are well above it. The 50-day SMA is at $150.08, also comfortably above. The 200-day SMA is at $170.85, and we are trading right at that level today. Just like Morgan Stanley, Oracle is testing its 200-day moving average. This is the line in the sand. A sustained hold above the 200-day would be very bullish for the intermediate-term trend. The RSI is at 71.0, that is just crossing into overbought territory. It is not as extreme as Morgan Stanley's 80.6, but it does suggest some near-term caution is warranted. Volume is 24.9 million shares against an average of 38.2 million, a volume ratio of just 0.65. That is meaningfully below average, which is the one concern I have with today's move. A breakout above a key moving average on light volume is a yellow flag. We want to see conviction from buyers. Fundamentally, Oracle is one of the most compelling cloud computing stories in enterprise software. Their OCI Oracle Cloud infrastructure is gaining real traction as enterprises diversify away from AWS and Azure. The PE ratio of 30.67 is reasonable for a high-quality tech franchise with strong recurring revenue. The company has significant contracts in AI infrastructure and government cloud services. My rating is buy with medium confidence. The fundamental story is intact, and if Oracle can hold above the 200-day moving average, the path back toward $200 is very achievable. Support is at $150, the 50-day SMA, and resistance is at $195 to $200 where we saw significant price activity earlier in the year. My 3-month price target is $198. And last but definitely not least, we are closing out today's analysis with Nike, ticker Nike. The stock is up 3.19% to $45.61. Now, similar to Oracle, you need to understand the context of where Nike has been. The 52-week high was $80.17. Today we are at $45.61, that is a decline of more than 43% from the peak. The 6-month high was $68.78, and the 6-month low was $42.62. We are just above that recent low right now. The technical picture is mixed but showing early signs of life. The 20-day SMA is at $48.20, we are below it, which is bearish in the short term. The 50-day SMA is at $55.57, significantly above us, also bearish. The 200-day SMA is at $45.62, and this is the key level to watch. Nike is essentially sitting right on its 200-day moving average. This is a make-or-break moment for the stock. Here is what gives me some optimism. The RSI is at 30.8. That is right on the edge of oversold territory. A reading below 30 is considered classically oversold, and at 30.8 we are right there. When a high-quality blue chip like Nike gets to these RSI levels while simultaneously testing its 200-day moving average, that is often a setup that value investors start to get very interested in. Volume today is 17.3 million shares against an average of 22.2 million, a ratio of 0.78. Below average volume on an up day is not ideal, but given the oversold conditions, even modest buying pressure can move the needle. Fundamentally, Nike is going through a brand reset. They are dealing with inventory challenges, increased competition from brands like On Running and Hoka, and softer consumer spending in key international markets, particularly China. However, Nike's PE ratio of 30.01 is starting to look more reasonable as the stock has derated significantly. The brand still commands enormous global loyalty, and a turnaround in execution could unlock significant value. My rating on Nike is buy with medium confidence. This is a long-term value play, not a momentum trade. If you have got a 12 to 18 month time horizon and believe in Nike's brand recovery, these are genuinely attractive entry levels. Support is at $42, that recent 6-month low, and resistance is at $48.20 where the 20-day SMA sits. My 3-month price target is $52, representing a recovery toward the 50-day moving average as sentiment begins to stabilize. And that is a wrap on today's top 5 stocks for April 15, 2026. Quick summary: LCID is a stock to avoid as it tests 52-week lows with no fundamental catalyst. Tesla is setting up constructively at key moving average confluence. Morgan Stanley is overbought but fundamentally strong, wait for a pullback. Oracle is reclaiming its 200-day with a solid cloud story behind it. And Nike is offering a long-term value entry for patient investors. If you found this analysis valuable, please smash that like button, it genuinely helps the channel reach more people. Subscribe if you are not already, and hit that notification bell so you never miss our daily market breakdowns. Drop your thoughts on any of these stocks in the comments below, I read every single one. See you tomorrow, and as always, trade smart.